Good afternoon. My name is Alfreda Norman, Senior Vice President at the Federal Reserve Bank of Dallas, responsible for communications and outreach. And I have the great honor to serve as moderator for the Dallas Fed's first virtual town hall for 2021. Tonight's theme will focus on Rob Kaplan's economic forecast for 2021. Rob will start off the program with an opening statement addressing this very topic. Then we'll use the balance of the event to answer questions directly from you, our audience, on whatever topic you might be interested in. Speaking of questions, there are two ways to submit them. To submit a written question, click the Q&A button at the bottom of your Zoom window to open the questions box. If you'd like to ask a live question, click the raise the hand button to enter the queue and wait to be called upon. You'll be prompted to unmute your microphone and ask your question. We ask that you ask your one question as concise as possible so that we can get to others in the queue. Now it's my pleasure to introduce Rob Kaplan. Rob Kaplan has served as the 13th president and CEO of the Federal Reserve Bank of Dallas since 2015. He represents the 11th District on the Federal Open Market Committee in the formulation of U.S. monetary policy and oversees the 1,200 employees of the Dallas Fed. Without further ado, let's turn to Rob for his opening remarks.
All right, thank you, Alfreda. And I want to welcome everyone to this town hall session. We've been trying over the last several months to do these every quarter. And so I want to wish everybody a happy new year. And with that, let me jump right in. I'm going to talk a little bit about what happened in 2020, which I hate to even talk about it because it's a year I think most of us would like to forget, and then talk about what the outlook is for 2021. So as most of you painfully know, because of COVID and the lockdowns associated with COVID, we had a very severe contraction in the second quarter of 2020. And annualized GDP growth declined by about 33% in the second quarter of last year. As you've heard me say before, probably, as severe as that contraction was, it was a very brief contraction. And it's our judgment here at the Dallas Fed that the economy began to grow again in April and into May, and really for the remainder of 2020. We think, or it's reported, that third quarter GDP annualized grew by approximately 33%. So we had a second quarter contraction of low 30s. We had a third quarter rebound of the low 30s. And fourth quarter GDP was positive. And it's our best judgment, this hasn't been reported yet, but it's our best judgment that for the full year, US GDP contracted by about 2.25% to 2.5%. I mentioned that we started rebounding in April. We had fits and starts as we went through the year, as most of you know. And those fits and starts occurred because of resurgences in the virus. For example, in August, we had a resurgence that lasted for a couple of months. We started growing more quickly later in the fall. And as we all painfully know right now, we've had a resurgence in the virus over the last 6 to 8 weeks, and it's continuing and worsening. But even with that, mainly due to fiscal stimulus, GDP has still been positive. I thought at times last year that we might have negative GDP growth, but that didn't happen. People have been very resilient. They've adapted. But in particular, the thing that is so unusual about what happened last year is that normally when you have a contraction like we did in the second quarter, household income and consumer spending drop. That did not happen this time. Household spending and consumer income stayed solid throughout this pandemic, and that's primarily due to fiscal policy, and to some extent what we did in terms of monetary policy. But even though people are not flying and they're not going to restaurants and they're not spending on arts and entertainment, it's not like the economy lost that GDP. It's because household income was strong, consumers shifted their spending habits to things they could do more remotely. And for many companies, if you're in a goods producing business or you're in a business where you can work remotely and deal with your customers or clients remotely, you might have even had a very good year in 2020. But if you were in and are in a person-to-person contact business, like a classic one being restaurants, travel, cruise ships, airplanes, and so on, you had a very difficult 2020 and you're having a very difficult time right now. If I look ahead though to 2021, it goes without saying that we think that at the Dallas Fed, the next couple of months are going to be a rough, very challenging couple of months, again, because we're grappling with this resurgence in the virus. And what we're watching very carefully all through the United States is ICU capacity, hospital bed availability. There's been shortages of healthcare workers in certain cities. And so all that's limiting mobility and engagement, and we're going to have a challenging next couple of months to get through. Despite that, we now think that at least GDP growth in the first quarter is probably going to be positive. It's not going to be a big number, but it's going to be modestly positive. And our full year forecast for 2021 right now is approximately 5% GDP growth for next year. That's our baseline. And I could think of scenarios where it could be greater than 5%. So we're going to have a challenging first quarter, and a lot of our GDP growth for next year is going to be weighted toward the latter parts of the year, but we're going to have a solid year of growth next year. That assumes that we continue to vaccinate people, that the vaccine is more widely distributed as we head through the spring. And as we vaccinate a greater and greater number of people, we're going to have a greater and greater return in mobility and engagement. And we're not going to get back to quote unquote normal, but we're going to be through 2021 working our way toward getting back to normal. And so we're going to have a solid year of growth. I'll just mention the unemployment rate ended 2020 at approximately 6.7%. But what I look at more is a figure called U6, which is unemployed plus discouraged workers plus workers working part-time who would prefer to work full-time. That figure was around 12%. And we noticed to end the year, and we noticed in the most recent jobs report, it dipped to at about 11.7%. But I think that 11.7% U6 is a pretty good indicator of labor market slack, and it tells you that we've got a lot of it, and there's a lot of people, even if they have a job, either they don't have a job, or if they have a job, they can't get enough hours. And so we've got our work cut out for us through this year to drive down that number. But if we do grow at 5% this year or greater, we think the unemployment rate is going to dip below, by the end of 2021, is going to dip below 5%. And our best judgment right now is it'll be in the neighborhood of 4.5 to 4.75. Forecasts tend to get revised. This is one forecast that I'm sure will be revised as we head through the year. But I think there's a reasonable chance, while there's downside risk, and certainly the next few months is going to be challenging, I think there's also a possibility that forecast is going to get revised upward, particularly if we have more fiscal stimulus and more fiscal activity. Okay, so let me talk about 2 or 3 aspects of this pandemic and this economy that have been unusual by historical standards, and then I'm going to stop there and turn it back over to Alfreda. I talked about household income being solid, that's very unusual. The second thing that's unusual is the way this pandemic disproportionately affected certain kinds of businesses and certain types of workers. So as I just talked about a few minutes ago, if you're in if you're in a person-to-person contact business, service sector business, it's affected you very negatively, and you haven't recovered, and you're still struggling to recover. And this is why many small businesses are struggling to survive right now. On the other hand, I talked to lots of businesses and lots of industries who had very good years, and their businesses continue to be very good. So that's unusual. And the Great Recession, it pretty much uniformly affected businesses across the board. So we have a real divergence here. The other thing that's striking is how it's affected workers. If you've got a high school education or less, it is far more likely that you've lost your job and or lost income, and you're making ends meet through fiscal support and savings from the fiscal support. If, on the other hand, you've got some college or a college degree, you are far more likely to be in a job where you can work remotely. You're far more likely to have kept your job, and you may not have lost income at all. And this is very unusual, particularly comparing it with the Great Recession. And I'll just throw out some statistics. If you've got a college education, if you've got a bachelor's degree, the unemployment rate for that group right now is 3.8%. Okay, some college, if you at least completed some college, the unemployment rate on average is 6.3%. If you've got a high school education, for that group of workers in this country, the unemployment rate is 7.8%. And if you've got less than a high school education, the unemployment rate is approximately 9.8%. These are all numbers from the Bureau of Labor Statistics and the jobs report that just came out last Friday. That is a big divergence. Related to that, if you're a woman, particularly a woman with children, it is far more likely in this downturn than in the Great Recession that you've left the workforce. And we're seeing a meaningful drop in participation, labor force participation for women with children. Even if you've got a college degree, your participation has dropped because you've made the decision or had to be forced to make a decision to stay home with your kids because of the nature of education and what's going on in the pandemic. And this is cascaded down to women with a high school education or less. And I think all these statistics reinforce to me and reinforce to our team at the Dallas Fed, and Alfreda is acutely aware of this as she runs our community outreach effort. As we come out of this pandemic, we're going to really have our work cut out for us to get women back into the workforce. And we've been talking a lot about the need for more availability of and access to childcare. And this really brings up how important that is. But it's very critical that we're able to get women's participation rate up. And we're going to have to beef up and really invest more in skills training and other programs that get those with a high school education and less back into the workforce. Why is this so critical? GDP growth is made up of growth in the workforce and growth in productivity. We've got an aging workforce. And I think in the months and years ahead, to the extent we can get women back into the workforce and get those with a high school education and less into the workforce more fully, we'll have better growth and we'll have better prosperity and we'll have a stronger economy. And so I guess of all the comments, I'll stop there, but I just want to set the table, and let me turn to Alfreda and then we can go a lot deeper in terms of questions.
Great, thank you, Rob. And just a reminder to folks, if you want to ask a live question, you can click on the raise a hand button on your screen, and that will put you in the queue, and then we'll call on you and let you know. So don't be shy. Rob, as you know, the Federal Reserve has been purchasing treasuries and mortgage-backed securities in an effort to help support the U.S. economy through the pandemic. The hot topic question that I keep hearing is, when do you believe the Fed will start cutting back on its bond purchases?
So we made a decision in our December meeting that we would keep buying 80 billion of treasuries and 40 billion of mortgage-backed securities. And we would do that every month until we are convinced that the economy has made quote unquote substantial progress in meeting our full employment and price stability objectives. We're obviously in the teeth of this pandemic right now, and my own view is we should be doing everything we can, including on bond purchases, while we're in the teeth of the pandemic. But if we're able to more broadly vaccinate the public, and that goes well through the spring and into early summer, I'm hopeful that the economy will rebound in the way I just described, and that by sometime later next year, we will have made substantial progress. I don't want to prejudge that sitting here now, but I'm hopeful that if we're able to grow in the way I just described, sometime later next year, we should be at least beginning discussions about the thought of tapering, meaning we'll still buy treasuries and mortgage-backed securities, but we can begin in earnest the discussion about tapering back the size of those purchases. But we'll just have to see how the economy unfolds this year to see when we reach that point.
I saw someone wrote in a quick in the chat box. Do you believe rates will ever go negative in the United States?
I would be strongly against the use of negative interest rates in the United States. I guess on the one hand, in this job, you never say never, but I, based on everything I know, I'd be firmly against it. Why? I'm not convinced. They've been used extensively in other parts of the world. I'm not convinced at all that they've helped growth. And in addition, it negatively affects savers, and it affects financial intermediaries. We have a big money market industry, for example, in this country. Many companies borrow in the commercial paper market, which depends on a strong money market industry. I think that the negative impact it has on intermediaries and on the financial system, I haven't seen enough evidence that it's being offset by helping prospects for growth. So I'd be very skeptical about use of negative rates.
In your remarks, you talked a lot about the macroeconomy. What is your forecast for Texas?
So Texas, the shape of the recovery is, I think, in Texas pretty much mirrors what I described to the country. Severe contraction, second quarter, strong rebound, or a rebound at least the rest of the year. And the resurgence we see in Texas is having a very negative effect. And in some cities in this state, El Paso being an example, but other parts, the resurgence here has been worse than other parts of the country. Having said all that, and obviously we can talk about the oil and gas industry, and I'm sure we'll get into this. The oil and gas industry has really had a big headwind all through this year. Despite all that, the story of Texas over the last many years is a very diversified economy, increasingly, and migration of people and firms to the state. And I've been struck during this pandemic, migration of people and firms to the state has been strong up until the pandemic, and it's gotten, I'm about to say it's gone parabolic. It's gotten a lot stronger since this pandemic started. And I'm seeing people from all over the country either coming here or thinking about coming here. So I think the prospects for Texas are very bright. So if the US economy grows by 5% next year, Texas is going to do similarly well. And I think there's a reasonable argument that Texas could well outperform the country for the next several years. And that's mainly because this migration, which is fueling more rapid growth in the workforce than other parts of the country.
Well, then we have a question did come in. Let's talk about the energy industry. What is the prognosis, both in Texas and worldwide?
Yeah, so we had a situation this year where in the first half of the year, the energy business not only had a supply shock, but had a demand shock, meaning before the pandemic even got in full force, those of you remember that Russia and Saudi Arabia and the rest of OPEC were unable to come to an agreement, and Saudi Arabia made the decision to dramatically increase their supply at a time where demand was beginning to contract precipitously. And so it created a huge inventory overhang for the industry. And what we saw is drilling meaningfully decline, and we started to even have producing wells shut in because it wasn't economic to keep producing. A lot of those shut-ins have now been reversed, but when it's all said and done, in 2020, the U.S. started the year with production growth of 12.8 million barrels a day. It ended the year with daily production around 10.8 million barrels a day. So dramatic decline, dramatic cut in CapEx, and the industry has been capital starved in that very little new capital has gone into the industry. We think it won't be until early 2022, and we'll have to see how the year unfolds before supply and demand globally will get back into balance. Having said all that, we all see that the price is firming. The only caution, people in the industry tell me this time around, they're committed to the extent that they are higher prices, they're committed to returning more of that cash flow to shareholders and not to putting as much of it in drilling. They'll put some of it in drilling. And because the industry doesn't have great access to capital, a lot of the drilling CapEx is going to have to get funded from cash flow. So I guess the long and the short of it is our best judgment at the Dallas Fed is that at 10.8 million barrels a day I talked about that we ended the year, it'll stay about flat next year. Now, that's a lot better than it sounds because the decline curve in shale is so significant. If production growth stays flat, it means we're having a lot of new drilling activity to just keep flat. But our best judgment is production growth will stay flat. And it would not surprise us to see prices continue to firm as we head through 2021. So it's going to be a more consolidated industry. There are going to be fewer players. They're going to have less access to capital. They're going to be much more disciplined in spending on drilling. But the world's going to need a healthy fossil fuels business, even with dramatic growth in solar, wind, other alternatives, battery storage. This industry is going to need to serve the United States and the world for decades to come. Fossil fuels will become a smaller and smaller percentage of world total energy production and consumption, but it's still going to be a critical industry.
How about the U.S. trade policy? How has that impacted the Texas economy?
Well, Texas is the largest exporting state in the country. And so a lot of the trade issues that we've been dealing with over the last couple of years have been a challenge. Now, having said that, the key for starters for not just Texas, but for the United States was shoring up our relationship with Mexico and Canada, because a lot of the integrated supply chain and logistical relationships that are critical to Texas firms as well as U.S. firms are with Mexico. That's why a high percentage of our imports from Mexico is U.S. content. A high percentage of our trade with Mexico are intermediate goods. They're goods that go back and forth across the border. So we felt very strongly at the Dallas Fed, because we do a lot of work on this, that shoring up North America trading relationships was critical to U.S. competitiveness. U.S. jobs have allowed U.S. companies to domicile here and add jobs here. So we were glad that USMCA got done. And to the extent that we've got healthy trade relationships, the U.S. has been taking share and North America has been taking share from Asia. Obviously, we've got issues, and many companies here have issues with their trade relationships with China. And we'll have to see how this all unfolds. But I would expect continued tensions. But I think trade and exports will still be a critical part of the U.S. economy. Not like it is in Europe, by the way, but very critical here, and certainly critical for Texas. And I'm hopeful that we'll have as a country with 5% of the world's population, less than 5%, trade relationships and using these logistics and supply chain arrangements are going to be critical to Texas and critical to the U.S. And so I'm hopeful about the future, how all this unfolds.
Right. Before we leave the great state of Texas, I did want to ask you, you mentioned in your remarks about the pandemic's education and gender impact. What about racial ethnic disparities?
Well, so the unemployment rates for Blacks and Hispanics, in fact, I'll give you the number. It just happened in front of me. The Hispanic unemployment rate right now is 9.3% in the United States. The Black unemployment rate in the United States is 9.9%. And so that those comments I made earlier about educational attainment relate specifically because Blacks and Hispanics as a group have tended to be more likely to be high school educated and less. So to this point, it's critical. And obviously, as you know well, Alfreda, because we spent a lot of time on this, it's critical that we improve the education ecosystem if we're going to have a faster growing economy. And that starts with early childhood literacy. That might be half day to full day pre-K, higher quality pre-K, access to daycare, particularly with an emphasis on literacy, improved secondary education, college readiness, and beefed up skills training. And so I'm very pleased that the Texas legislature passed education reform in the session 2 years ago. I think that's critical for the future of Texas and the future workforce of Texas. And it's critical that we don't give back those gains and we continue that progress, because these are the fastest growing demographic groups in our state and our country. And to the extent we can improve educational attainment, we'll have a faster growing economy. This is our workforce of the future. So I think it's essential to business prospects for the state.
Great. Well, we don't have very many hands raised, but we have lots of questions pouring in. So I'm just going to rapid fire with them. And some of them are in categories, but we might skip around. But this one is really, we've got several questions from our viewers, our audience. So I'm just going to get right to it.
All right.
How will monetary policy change with the new administration?
The new administration, the fact there's a change, that by itself is not going to affect monetary policy. The thing that could affect monetary policy, though, is to the extent that there's more fiscal stimulus, either infrastructure spending or other fiscal stimulus, that's going to translate into economic growth. And I think that'll be a big factor that we have to take into account in terms of appropriate monetary policy. But in the near term, while we're fighting and in the teeth of this pandemic, again, we're going to need to be doing everything we can to fuel a rebound and a recovery. But I think as we move out to the point where we're showing evidence that we're weathering this pandemic, and depending on what other actions are taken by other parts of the government, particularly fiscal policy, that'll have an effect, I would think, how we think ultimately about our asset purchases and about the timing of when our full employment and price stability objectives are met.
Great. I'm going to now look to our audience. I'm going to turn to Clifton Miller. And Clifton, we're going to unmute you and you should be ready to ask your question.
Thank you very much, Mr. Norman. Thank you, Mr. Kaplan. You've already answered one of my questions, but I've been to numerous events over the last 10 years. And we talked about the Texas Miracle. We talked about the robust economy of Texas. And I've gone to numerous events there to Dallas Fed, and people get up and they cite all these great statistics. The operating reality is it depends on what zip code you live in.
Right, agreed.
As to are you a beneficiary or a victim of that Texas Miracle? So inside of that, so one, do you have some, because we don't talk, when we talk about how great the state of Texas is, we don't talk about where we rank in education. We don't talk about where we are in terms of, we lead the country in uninsured citizens. Right. So that's one thing. And the other thing is the hard cost of of the hard cost of poverty and inequity, are there any models that really look at what in terms of public safety costs and public health costs? Those are hard dollar costs that impact taxpayers. The hard dollar cost of unemployment. But we have this reluctance to invest in social programs or healthcare programs. So is there an economic one? Let's just talk about, why don't we really talk the truth about the Texas miracle?
Okay.
And two, are there any models that truly look at their hard dollar costs associated with the cost of poverty? That costs the taxpayers money.
Yeah. So Clifton, you've been, it sounds like you've been to a number, as you witness a lot of the events we've done here, we haven't been quite so ebullient about the Texas miracle as you described. We actually wrote a book on the subject, and in all our presentations, we're always quick to point out Texas lags the country in terms of educational attainment, and that's particularly true for Blacks and Hispanics. We spent a lot of time on that, and as you just said, rightly, we have the largest number of uninsured. And that's been critical to us. And we spend an enormous amount of time at the Dallas Fed and throughout this district out in the community and working to try to address and improve, again, early childhood literacy, secondary education, improved access to healthcare, skills training, the digital divide, access to financial services. And why do we do that at the Fed? Back to your comment on the model, we've consistently argued in all my essays and in town halls we've argued that if we don't dramatically improve childhood poverty, not just in Dallas, but in Houston and other cities here, and improve educational attainment, we're going to grow more slowly in Texas. Our median income is going to be disappointing. And we're not going to have the workforce we need to have growth. And so we think that addressing these disparities and these issues you've talked about are central to improving economic growth. And I spent a lot of time in Austin, in addition, and we spent a lot of time on the recent education legislation, trying to make these arguments. And I think leaders of the state and in this city and other cities in our state are realizing that we've got to make dramatic improvements if we're going to reach our potential and have prosperity for all of us in the state. And to your point about the public safety and healthcare costs, we actually have tried to articulate the cost in terms of lost growth and lost not only workforce growth, but lost productivity, lower tax revenues that come about from not closing these disparities. So we're working very hard on this at the Dallas Fed and trying to mobilize the communities that we serve to focus on these issues. And we've made progress, but we've got a lot more work to do. I don't know, what would you say about that, Alfreda, by the way? Anything to add? Because you've spent your life on this.
Yeah, well, I would agree. I think that was a good question to be asked about the cost. What is the cost of not really solving the issues, the disparities? I think, as you made in your comments, Rob, we realized that the underlying things that we gain from doing this is just so much greater than not doing this work. So yeah, expanding educational attainment, working on ways in which people can get new skills training and job training, that will only expand our economy and make everyone, it will be better for everyone. So it is something that we're working on. And speaking of the GDP, just to clarify, Rob, you'd mentioned in your economic forecast, you said, I just want to clarify, you asked, you said the forecast, the clarifying that he's taking, you're talking about 2021, not 2022, when you said next year.
Correct. Yeah. You know, I have to remember that we're in 2021, which I forget nowadays. But yes, the forecast for the year we're in is 5%. Mm-hmm. And oh, by the way, I'll make one comment. And Alfreda, we've talked about this a lot, and we've said this, you know, lots and lots publicly. You know, dealing with these educational attainment gaps, dealing with poverty, closing racial disparities, improving access to healthcare is the highest return on equity investments we can make as a society. That's our belief here at the Dallas Fed.
Yeah. We have a question from Jason. Jason, I'm going to unmute you, Jason, and you're ready to go. If you've got.
How are you?
Hey, doing well. Thanks, Rob. So President Kaplan, I guess the first is a clarification and then a question. When you're talking about the asset purchases, is that when you said later next year, is that later?
Later this year, I apologize. Yeah, I've got later in 2021. That is what I meant to say. If we, now, I don't know if the year's going to unfold that way, but if the forecast I just described, if we actually realize that later this year, my own view is we should at least be having an earnest discussion about when it's appropriate to taper. I don't want to prejudge right now while we're in the teeth of the pandemic, whether when we're going to get there, but I would hope it might be this year.
Yeah, and then the question was, to tag on to that, obviously when you're in the teeth of a pandemic and when the health situation is adverse right now, it doesn't make sense to talk about reducing asset purchases.
Right.
But later in the year, if kind of a positive economic situation happens, if we're 5% or possibly with a positive bias to that, does it make sense? We're already stimulating with low interest rates or essentially zero interest rates. Does it make sense to double down on the stimulus with asset purchase layered on top of that?
Yeah, listen, you've heard me say this before, because a lot of people say, why do you even want to start speculating right now? We're in the teeth of this pandemic. Why would you even start speculating about when you might taper? And why did the Fed need to even come out with guidance in December? And here's the reason why. I think we should be aggressive as we can be right now while we're in the teeth of the pandemic until we're convinced that we've weathered this pandemic, and we're not out of the woods yet. Having said that, once we are out of the woods and convinced that we're weathering this pandemic and moving forward and making progress, I think it's a lot healthier for the US economy and for the markets to wean off these extraordinary actions and this extraordinary stimulus. I think we'll be stronger for it if we're able to gradually wean off this support. But right now it's premature to speculate on when that would be, but I'm hopeful that as we move beyond this pandemic, we'll later this year, we'll be able to start in earnest having that conversation. I think it'll be a healthy conversation.
I'm going to go to John. John, you're unmuted. You can ask your question.
John, you may still be unmuted.
Yes, okay. I'm sorry. So I was very struck by your characterization of firms, people moving to Texas. You just sort of, it's turned into a vertical line almost.
Yeah.
That vertical line is a dip from where I'm sitting in Silicon Valley, California.
Right. And by the way, just for those who don't know, John is a great friend of the Dallas Fed and is former Undersecretary of the Treasury and is just spoke here at the Dallas Fed and is one of the great professors and thought leaders in the country on monetary policy. So I'll just give you that introduction. Let's keep going.
Thank you for saying that. This is my question is not about monetary policy. I don't think so anyway. But part of the stampede, if you put, is out of where I'm sitting. Oracle's moving, HP's moving, Schwab's moving, and many others. And to some extent, it's because of a different regulatory climate. And I think Schwab may be part of that exactly, at least the financial side. And it's also related, I think, check with you on this, to the growth of non-store sales, e-commerce. It's easier to be another place. And so the question is this something, is it a regulatory issue, monetary issue? Is it just tax issues? Or are there things that we should be addressing this? Because it's a massive flow of people and firms. Yeah,
I've been struck by it. As you mentioned, Schwab has moved from California to move to Texas. But I'm having conversations with people I've been friends with for 30 years who are CEOs of businesses and are moving here from Illinois, New York, California. So what do they tell me? There's a combination, to your point. One of it is to some extent the regulatory climate. Easier to start a business, get permits. Another is taxes. You can't get around it. We don't have a state or we don't have a corporate or personal income tax here. And so taxes are affecting the thinking of some people. The central location, we've got a lot of distribution facilities that are being built here and others that want to be more centrally located. And the other comment I hear from people is a little bit just the business tone. It's a more quote unquote pro-business tone. And listen, we've got some vulnerabilities in Texas too. We just talked about them. We've got to improve our education system. We've got to improve our access to healthcare. But those are 3 or 4 of the reasons that I'm hearing from people that are moving here from California and other places. And while it makes me feel very good for the prospects for Texas, it worries me greatly because many cities and states in this country are going to need to raise revenues, particularly in light of the fiscal hole that we had because of the pandemic. And they're realizing they're not going to be able to do it because they're going to lose more people and more businesses. So I think this is, while it may be in the short run good for Texas, I think it creates a real challenge for the country. And I personally think it's in all our interest in the country for us to be broadly strong. And so I'm a little concerned about it.
All right, we have a question from Stan. Stan is still there. He might have. I'm going to jump to Christopher.
Hi, thank you for taking my question. Recently, I just reviewed a report that your colleague, James Bullard from the St. Louis Fed, just had a discussion in front of an Arkansas group, and his comments are quite interesting, stating that the U.S. monetary and fiscal policies have been exceptionally effective this year and were designed for a larger shock than the one that actually occurred. He said that U.S. monetary and fiscal policies have been exceptionally effective during the crisis, and current levels of financial stress are at pre-pandemic levels. Additionally, as you stated earlier, the unemployment rate has made a lot of progress, finishing the year at 6.7%, which is the same place as March of 2014. So why is monetary policy supporting so much more fiscal spending at this stage? And what is so different now when comparing the economy to 2014?
Yeah, so I won't speak for Jim, but I've talked at length with him, and I spent a lot of time with him, and I know his views. His point, for starters, has been that and he's argued this publicly. I'm not saying anything that he hasn't said publicly. Is that the fiscal support has been sufficient, he thinks, to pull us through this. I'm not going to get into that debate because it's not our bailiwick, but he wants to emphasize that. I think, on the other hand, I won't speak for Jim, so I won't even try to. I'll speak for myself then from here. Again, while we're in the teeth of an unprecedented pandemic, it's made sense to do extraordinary things in terms of monetary policy. But I think it's important to recognize we have had good fiscal support, unusually good, and we may get more. And so that just reinforces my view that as we get evidence that we're weathering this pandemic and we're making substantial progress on moving toward full employment and price stability, at some point in the future, we ought to be talking about beginning to let some of these programs lapse and weaning off some of these extraordinary actions. And I think it'll be a healthy thing to do that. So let me stop there.
I'm going to change gears a little bit. I have a question that was written in. What relationship do you see the U.S. having with China, and what effect will it have on the U.S.?
So obviously the big change in the last couple of years in our relationship with China is we for years have had a real issue about whether there was a level playing field between our companies and theirs in terms of reciprocity, in terms of a level playing field. And second, intellectual property rights and technology transfer, okay? The last administration, the current administration that's about to be outgoing, has used tariffs to try to deal with those issues. But I would tell you, it's our own view at the Dallas Fed that because of the issues with China, it was essential to shore up North America, i.e. our relations with Mexico and Canada, and think of Northern Hemisphere as a competitive bloc, competitive hemisphere, and I think we've now gotten there. But I think that the tension with China on level playing field, intellectual property rights and technology transfer is going to go on for the rest of our lives, most likely. In certain areas, we'll find ways to cooperate. In certain areas, we're going to be rivals and competitors. And I think we'll be wrestling with these issues for a long time. Having said that, there are areas where I think it's in our interest to cooperate, and we will be a stronger country for it. And the challenge will be to have these dual tracks of where do we cooperate and where is there tension and where we're competitors, and we've got to stand up for our rights. And I think that's going to be the dynamic we're going to be living with for some extended period of time.
We have a question from Bill. Bill, I've unmuted you. I still, you, let's see.
Can you hear me?
Yes, we can hear you now, Bill. Thank you.
Good. Oh, well, thanks, Mr. Kaplan and Ms. Norman. It's great to see you guys. And I think you're doing a generally fabulous job. My questions tend to be, as an amateur historian, I see the massive issuance of debt and the massive purchases of bonds and mortgage-backed securities. And I can't help but think of Weimar Republic, which I know you guys sitting on the board all discussed at length. So, and I've actually had the opportunity to speak with you. You probably don't remember it, but about unintended consequences of keeping interest rates low.
We have spoken about this, yeah.
Yes, yes, we did. Anyway, please convince us that we're not headed for the Weimar Republic and everything's going to be okay.
Well, I wish I could do that, but I don't know that I can. I don't think we're heading for the Weimar Republic, but I have been pretty vocal in saying that, and we said this pre-pandemic, the path of U.S. government debt to GDP, we're concerned here at the Dallas Fed that path is likely unsustainable. And I'm talking about debt held by the public as a percentage of GDP, which is now approaching 100%. I think when we pre-pandemic, earlier in 2020, it was in the 70s. It's now close to 100, and the present value of unfunded entitlements is well in excess of $55 trillion and growing. And so we're going to have to find ways to moderate our debt growth. Now, obviously, because of the pandemic, we've taken extraordinary measures, not just on monetary, but on the fiscal side. But again, as we get beyond this pandemic and we start moving toward progress toward full employment and price stability, I'm sure the country is going to have to wrestle with ways to moderate this debt growth. How do you do that? All sensitive topics, entitlement reform, and we're going to have to find ways to grow faster. This is why I've made a big deal for years now. We've got to find ways to grow the workforce, improve productivity, and that's why we've talked about a range of ways to do that, including improving education, getting women more fully into the workforce, things like that. We're going to have to grow faster, but I don't think that this rate of increase in debt to GDP our own view here is it's not sustainable, and it's going to have to be addressed in the months and years ahead. And so this is going to be a big challenge for us.
I have a question that was written in. What do you see as the biggest risk for the US and the international economy in 2021?
There's short-term risk and long-term risk. The biggest short-term risk is that we can continue to disseminate widely an effective vaccine, and that we ultimately get to a high enough percentage of our populations that we've got control of this virus and we can start getting back closer to something close to normal. The biggest risk would be something that impedes that wide dissemination that keeps us getting back to quote unquote normal. That to me is the biggest risk. And we're going to have to unify. We've talked a lot here, and we're just having, afraid of this conversation. What unites us is far stronger than what divides us. And it is in our national interest to come together to make sure that we accomplish and execute this broad vaccination and get this economy and our population so we can move beyond this pandemic and fight this pandemic. So that's the issue for 2021. In the longer run, I do believe this issue of being able to wean off ultimately in the years ahead extraordinary monetary policy pressures, finding ways to grow and to moderate our debt growth. I think that's a longer term issue that we and other countries around the world are also going to have to face.
We have a question from Amit. Take you off mute.
Thank you for taking my question. President Kaplan, can you please comment on the impact of technology on the US economy and perhaps on the Texas economy as well? And do you believe that the technology sector, as a result of the pandemic, perhaps is experiencing a little bit of a ebullient overreaction? And is it likely that when the economy returns back to some measure of pre-pandemic environment, do you think that the technology sector would experience a cool down?
Yeah, so even pre-pandemic, and we've done 2 conferences on this here, and we'll do a 3rd here in May. We've been a strong believer, and I'm a strong believer over the last years, that technology and technology-enabled disruption is accelerating in the US economy. The pandemic has just simply accelerated it further. And what do I mean by that? Platforms that allow people to work remotely, allow people to buy goods and services remotely, that disrupt old models. I think that trend, it's been with us for the last several years. It's accelerating as a result of the pandemic. And it's one of the trends I don't think we're going back. I think this trend is going to continue. And most companies I know, as a result of that, are spending more on technology and investing more in it because they realize they need it for their survival. And that starts with, we have one of our board members owns a Dairy Queen, and he's explained to us even to be viable as a Dairy Queen, they've had to invest much more in remote ordering and in technology so they can be competitive. But this is going across industries. And I think this trend is going to continue to gain speed. And it's having a pretty fundamental effect on the economy. And so it's limiting the pricing power of many businesses, and it's affecting the workforce. Lastly, again, if you've got a college education or better, you're probably a beneficiary of technology and technology-enabled disruption, and that you've got the skills and education to benefit from it. If on the other hand, if you've got a high school education or less, you may see this trend, technology and technology-enabled disruption is causing your job to more frequently be disrupted, restructured, or even eliminated. And this is why we've got to really make more progress than we have in improving educational attainment, early childhood literacy, but skills training in addition that allow people to adapt and get retrained, because I think the degree of movement and restructuring of jobs because of this trend is accelerating, and we've got to help our workforce become more adaptable. And I think that's one of the big challenges of our time, and it's a lot of the focus of our community work here at the Dallas Fed.
Dennis has a question. Dennis, you're unmuted.
We've had some good regulatory policy and good tax policy over the last 4 years. Now we're facing significant tax increases into this new administration and ramping up the regulatory environment again. We saw in 2019 possibly the best economy we've seen in multiple decades, resulting in rising wages, lowering poverty levels for the first time in our history. What effect are we going to now see with the Biden plan? And do you believe they will move forward even in view of the COVID crisis with these tax policies and regulatory controls?
So I'll be careful not to get into the as you would expect me to, the political elements of this, and to stay on our monetary policy lane. But yeah, I think we're going to have to see how policies unfold. And they may not unfold exactly in the way people think. I think there will be, some of the things I think are clear. I think there'll be more emphasis on sustainability, alternative energy, greenhouse gas emissions. I don't know that it's not as clear to me, in light of the political situation, again, which I'll stay out of, is what really will be forthcoming in terms of tax policy. And I do think we have benefited in many ways in the economy over the last 4 years. Our analysis would suggest, from some of the regulatory review that's been done, and that has helped. And I think that's probably not been lost on people that on both sides of the aisle who've been watching. Having said that, there are certain areas where we probably need more regulatory oversight. But I think the jury's very much out on this. And our job at the Dallas Fed will be to digest what the policies are as they unfold and try to factor them in. And when we're asked, give advice to policymakers on both sides of the aisle about what their implications are.
Well, Rob, our time is just about up. I've got one final question to ask you. Can you suggest one specific area of focus that will provide today's audience with confidence in our economic future?
Well, I think it should give us a lot of confidence that I do believe, assuming, which I believe will be the case, that while the vaccination hasn't occurred at the rate we might have hoped, I still believe we're going to have widespread vaccinations as we get through the next few months and into the spring and into the summer. And we're going to have a solid year of growth in 2021. I believe that. The challenge will be for all of us to do things, I think, that help those who've been disproportionately affected negatively by this pandemic, to help them get back into the workforce. And I think to make fundamental changes in continuing to improve early childhood literacy, our education system, work on skills training. I think we've got a great opportunity here in Texas and in the country to grow this economy and to make improvements. But I think we'll have, as we get over the horizon, the next couple, 3 months are going to be very challenging and very difficult. But I'm hopeful as we get through 2021, we're going to have the wind at our back. And I guess the other comment I'll make again, I think we have a great opportunity in this country to make progress. And I would just say, as a citizen, again, what unites us, I think, is far, far greater than what divides us. I talk to people all through this district. I talk to people on both sides of the aisle, and I'm convinced that we've got much more agreement than disagreement. And we've got a real opportunity to make progress here in Texas and in the country. So I'm looking forward to that.
Thank you so much, Rob. And I would like to thank all of our audience members that have tuned in today with their thought-provoking questions. And boy, we had a really a large amount of questions. Couldn't get all of them in, but so happy to have your participation this evening. The Dallas Fed is committed to our communities and to sharing information broadly. If you're interested in hearing more from the Dallas Fed, please visit our website at dallasfed.org. And while you're there, you might also opt into events that we're going to have in the future. We'll have some more town halls and our Global Perspective speaker series. Until next time, thank you so much for tuning in, and we look forward to engaging with you again in the near future. Good night.